All right, welcome back to another episode of This Just In, another week with Frank McKenna. How are you doing today, Frank?
Doing great. What are we going to talk about today?
We are going to talk about credit washing. Not many people
Hmm.
talk about this type of fraud right now. I know it's becoming a little more mainstream, but
Mhm.
most people don't actually know what this is. So I think we'll set the record straight, talk about what we're seeing within our data, and maybe talk a little anecdotally about some of what our lenders are seeing. But credit washing, what is it? So systematic disputing of derogatory trade lines as identity theft, right?
Mm.
And we see this in multiple different ways. You can see that from a first party fraud where it's just someone with bad credit who's trying to wash it, trying to make it look better. You know, they have maybe a 550 credit score. They wash their credit by disputing every single bad trade line as identity theft. Those get
Yeah.
all dropped off, and now they look like a 750, but they actually behave like a 550. Or
Yep.
you see it on the other side, which we'll call kind of synthetic cleaning, where synthetic identities will do the same exact thing after they've busted out, claim everything is identity theft, clean that synthetic, and reuse it. Why go through the process of having to create new identities when you could just rinse and repeat?
Yeah, there's one other one that when I was investigating that I came across all the time, which was somebody claiming identity theft because their spouse took out an application while they
Mm-hmm.
were married, and they're
Mm-hmm.
claiming they knew nothing about it. And about, surprisingly, even at that time, about 40% of the identity theft claims we got way back then were actually rejected. So we actually
Oh
never
yeah.
accepted them because marital
The
dispute.
best part was
Divorce.
always pulling up the phone records and hearing that same person on the phone trying to dispute their payment amount.
Sure. Yeah.
Not getting any budge, and then 3 months later claiming it's identity theft. But we saw this in our data. You know, the 2023 as a full year is about 65 basis points. I think by the end of the year was actually higher than that, but it's about a 30% increase year over year. So a growing
Mm.
trend. I know you've been doing a little bit of work with some of our lenders on understanding their
Mhm.
identity theft claims, but maybe you can share with our audience.
Yeah. So we work with some large lenders, and surprisingly, 98% of the identity theft claims that are coming through, round about that, are rejected because they're actually the customer that applied for the auto loan. This is auto lending specific. So 98% of the identity theft claims are not legitimate, which is pretty shocking that only 2% of these identity theft claims are actually legitimate.
Yeah. Well, I mean, you look at the FTC data back in 2017 when they dropped the requirement of a police report to claim identity theft. You see claims just skyrocket when if
Mhm.
you look at their Sentinel Network data book. After you remove accountability, people can just claim over and over and over and over again. And the rubber stamp comes out when you can't keep up with the claim volume. You got 30 days to investigate it, according to
Yeah.
the FCRA. And
Mhm.
if you don't, then you're on the hook. So these financial institutions can't keep up
Mhm.
with the volume. And so you just start coming out and saying identity theft, identity theft, identity theft, and writing them off.
Yeah, well, one thing that happened alongside that change was it made it really easy for a credit repair company to do it on the behalf of the consumer by
Hmm.
basically filling out cookie cutter letters and faxing them from a single location to lenders and banks and finance companies all over the United States. They could do it from a central location. They could automate it. They could do thousands of letters. The consumer didn't even have to get involved at that point. So that's what I think happened was it resulted in a lot of automation of credit
Hmm.
repair and credit washing fraud that then we saw kind of hit the numbers when we saw big increases in identity theft claims right after that occurred.
Yeah. And eOscar made it even easier, where instead of having to go to each individual financial institution to dispute, you dispute it through the bureaus, and the bureaus automatically notify everybody.
Yep. I think what we'd warn lenders and banks is don't just accept an identity theft claim at face value. Do your investigation. Don't just remove it from the credit bureau and write it off because a lot of times you're going to find it's a legitimate trade line.
And on the application, don't just trust the credit score because that 770 might not actually be 7.
Right. Could be you could have cleaned your credit. You gotta look at the details.
Hmm. Well, thanks, Frank. I will talk to you next week. And thanks to our audience for tuning in to another episode of This Just In. Thank you for joining us on another episode of This Just In. If you'd like to know even more, head on over to pointpredictive.com for the latest fraud insights. Until next time, stay vigilant, stay secure, and stay one step ahead.